3%. That's what your employer gave you this year. Maybe 4% if you're lucky. Maybe 2.5% if they're managing costs. You worked 50-hour weeks. You exceeded expectations. You got promoted, and they rewarded you with an extra $3,000 on your $100,000 salary. Congratulations. After taxes, that's $150 per paycheck. You can almost afford the inflation on your grocery bill. Meanwhile, the company you work for just reported 22% profit growth. The CEO got a $4.7 million bonus. The stock jumped 31%. But you got 3%. And they told you to be grateful because it's a competitive market and we value our people. Here's what they're not telling you. That 3% isn't a reward. It's a prison. It's a mathematically designed system to keep you working for them until you're too old to do anything else. And today, I'm going to show you the exact numbers that prove your employer's math makes retirement impossible. Let's start with the lie you were sold. Work hard, climb the ladder, get annual raises, save 10-15% in your 401k. Retire at 65 with a comfortable nest egg. This was the promise. This was the dream. Now let's run the actual math. You're 30 years old, you make $75,000, you're good at your job, so you get 3.5% raises annually, above average. You save 15% in your 401k, which is more than most people. Your employer matches 3%, so you're putting away 18% total. The market returns 8% annually, which is the historical average. You do everything right for 35 years. At 65, you have $1.8 million. That sounds like a lot, right? Until you realize that $1.8 million in 35 years has the buying power of about $900,000 today after inflation. Using the 4% safe withdrawal rule, that gives you $36,000 per year to live on. That's less than half what you were making while working. You worked for 35 years, saved aggressively, did everything the system told you to do, and your reward is a 50% pay cut at 65 that lasts until you die. This is success in the employee model. But here's where it gets darker. That scenario assumes you never lost your job, never took time off for medical issues, never had to cash out your 401k for an emergency, never got laid off during a recession. It assumes uninterrupted employment with steady raises for 35 years. How many people do you know who've actually achieved that? The reality for most people is far worse. The median 401k balance for Americans aged 60-69 is $182,000. Not $1.8 million, $182,000. That's $7,280 per year in retirement income. That's $606 per month. You can't survive on that, which is why 43% of people over 65 are still working or looking for work. Now let's contrast this with what happens if you own instead of work. Let's say at 30, instead of climbing the corporate ladder, you start a simple service business. Pressure washing, lawn care, cleaning, something unsexy that solves a basic problem. Year 1, you make $60,000, less than your salary, but it's yours. Year 2, you hire one person and do $120,000 in revenue. You keep $75,000. Year 5, you have 3 employees, you're doing $300,000 in revenue, you're keeping $120,000. Year 10, you've systematized it. You have a manager running it. It does $500,000 in revenue. You keep $150,000 and you work 10 hours a week. At 40, you sell this boring business that nobody thinks is impressive for 3x revenue, $1.5 million. After taxes, you have about $1 million in cash. You invest that at 8% returns. That's $80,000 per year in passive income. At 40 years old, while your former colleagues are celebrating their 3% raise to $95,000. This isn't a fairy tale. This is the boring math of ownership versus employment. One path compounds your time. The other rents it out at a 3% annual increase. Here's the trap employees fall into. They confuse stability with security. A salary feels stable, steady paycheck, health insurance, paid time off. It feels safe. But it's the opposite of secure because your entire financial future depends on one entity continuing to employ you. One recession, one merger, one restructuring, one new boss who doesn't like you, and that stability evaporates. Contrast this with someone who owns 3 rental properties. Each property could have issues, but all 3 aren't going away simultaneously. That's diversification. That's real security. Multiple income streams that don't depend on one person's opinion of you. Your employer knows something you don't want to accept. You are more profitable to them than they are to you. Always. That's not evil, it's just math. If you generate $250,000 in value and they pay you $100,000, they profit $150,000 from your work. This gap is called surplus value, and it's the foundation of every employment relationship. Some people argue, but I don't have the risk of business ownership. You're right. You've traded business risk for career risk, and career risk is often worse because you can't control it. A business owner who fails can start another business. An employee who gets fired at 55 has limited options. Age discrimination is real. The stability you think you have is an illusion. Let me show you how the 3% raise actually functions as wealth suppression. Inflation averages 3% historically, so your 3% raise isn't a raise at all. It's just maintaining your purchasing power. You're on a treadmill running at the same speed as the belt. You're not moving forward, you're just not falling off. But it gets worse. Lifestyle inflation tends to match or exceed raises. You get 3%, you spend 4%. New car, bigger apartment, more restaurants, small upgrades that feel justified because you got a raise. You're actually getting poorer each year while thinking you're progressing. Now here's the math that should terrify you. Let's say you make $100,000 at 30 and get 3% raises until 65. At 65, you're making $280,000. Sounds great until you realize that $280,000 in 35 years has the same buying power as $140,000 today. You've doubled your nominal income, but only grown your real income by 40% over 35 years. That's about 1% real growth annually. Meanwhile, if you'd started a business at 30 and grown it by 15% annually, modest for a small business, you'd be making $13.2 million per year by 65. Not inflation adjusted, actual dollars. The gap between employee mindset and owner mindset isn't small. It's generational wealth versus working until you die. Here's what employees don't calculate: the opportunity cost of their time. Every hour you work for someone else is an hour you're not building your own asset. You're spending your most valuable years, your highest energy, your peak earning potential, building someone else's wealth. You get paid. They get equity. One of those compounds, one of those evaporates. A 2022 study from Georgetown found that the average employee in their 30s spends 2,400 hours per year working. If they redirected even 500 of those hours toward building a side business, within 5 years, most would surpass their salary income from their side venture. But they don't. Because the salary feels safe. Because the 3% raise feels like progress. Because they've been conditioned to trade time for money instead of building assets that generate money. Let me tell you about Sarah. Sarah worked in marketing for 12 years, started at $55,000, worked her way up to $92,000 by 35. Good raises. Solid career. Then she got pregnant with her second kid and realized childcare would cost $2,400 per month. After taxes, her take-home was $5,200. After daycare, $2,800. After other child expenses, she was netting maybe $2,000 from working full-time. She quit and started a freelance marketing consultancy. First year, she made $48,000 working 20 hours per week. Second year, $95,000 working 25 hours per week. Third year, $160,000 working 30 hours per week. She's home when her kids get out of school. She has complete flexibility, and she's making more than she ever did as an employee. The difference? She stopped trading hours for dollars at a fixed rate. She started charging for value delivered. Her time compounds instead of being rented. Here's the retirement math that proves the employee model is broken. To retire comfortably, meaning maintaining your pre-retirement lifestyle, you need about 25x your annual expenses saved. If you spend $80,000 per year, you need $2 million. Using the employee path of saving 15% with employer match, starting at 30, you'll accumulate about $1.5 to $2 million by 65 if everything goes perfectly. But here's the problem. Most people don't start saving seriously until their 40s. Most don't save 15%. Most experience career disruptions. Most raid their 401k at some point. The median outcome is nowhere near $2 million. It's closer to $200,000. Now look at the ownership path. Buy one rental property at 30, cash flow positive $400 per month. At 35, buy another with equity from the first. Now you're cash flowing $800 per month. At 40, buy two more. At 45, you own 4 properties generating $2,000 monthly. You're 45 with $24,000 in passive income and $800,000 in equity. And you haven't even considered appreciation. Or start a business at 30, grow it to $500,000 in revenue by 40, sell it for $1.5 million, invest the proceeds in dividend stocks yielding 5%. That's $75,000 per year in passive income. At 40, not 65. The employee model requires 35 years of perfect execution to achieve a mediocre retirement. The ownership model requires 10 to 15 years of focused work to achieve financial independence while still young enough to enjoy it. So why do people stay employees? Fear, conditioning, and the golden handcuffs of benefits. Health insurance, 401k match, paid vacation. These benefits are designed to make leaving painful. They're retention mechanisms disguised as perks. But here's what they cost you: your freedom, your upside, your control. You've traded the possibility of wealth for the guarantee of comfort, and comfort is expensive when measured across a lifetime. Let me show you the math of the 401k match that keeps people trapped. Your employer matches 3% if you contribute 6%. On a $100,000 salary, that's $3,000 of free money annually. Sounds great. Until you realize that staying employed for that $3,000 costs you the opportunity to build a business that could generate $300,000. You're optimizing for a 3% match while ignoring 300% opportunities. This is the employee trap. You're solving for the wrong variable. You're maximizing benefits and salary while ignoring equity and leverage. You're playing checkers while business owners play chess. Here's your wake-up call. Every year you spend as an employee past 30 is a year you're betting that trading time for money is more valuable than building assets. That's a bet that loses over long time horizons, because time is the most valuable input in wealth creation, and you're selling it at a 3% annual discount rate. The system wants you to believe that entrepreneurship is risky and employment is safe. The opposite is true. Employment is the riskiest financial decision you can make because you're dependent on one income source you don't control. Business ownership is safer because you control your destiny and can create multiple revenue streams, but you've been trained since childhood to fear ownership and worship employment. Get good grades to get into college to get a good job. The entire education system is a pipeline to create employees, not owners, because economies need workers. But workers don't build generational wealth. Here's what you do if you're ready to escape the 3% trap. Start building a side business while employed. Use the salary as a safety net while you build your own asset. Don't quit immediately, but start redirecting your energy toward ownership. Next, calculate your real hourly rate. Take your salary, divide by hours worked, subtract commute time, subtract taxes, subtract work-related expenses. Your $100,000 job is probably generating $35, $40 per hour of actual value to you. You can beat that with ownership. Third, study boring businesses in your area making real money. The HVAC company, the plumbing service, the landscaping crew. These aren't sexy. They're also generating $200,000, $500,000 in owner earnings, while you're getting your 3% raise to $103,000. Fourth, shift from employee to entrepreneur mindset. Stop thinking about job security. Start thinking about skill security. Skills that create value anywhere are more secure than any job. Finally, understand that your 20s and 30s are your highest energy years. Spending them building someone else's wealth while accepting 3% annual increases is the most expensive decision you'll ever make. The opportunity cost compounds over decades. The 3% raise isn't generosity, it's a retention mechanism calibrated to keep you just comfortable enough to stay, but not wealthy enough to leave. It's designed to make retirement feel close enough to chase, but far enough to never quite reach. You can keep playing that game, or you can build something that's yours, something that compounds, something that creates real wealth instead of the illusion of progress. The choice is yours, but understand this: every year you accept 3% is a year you're choosing comfort over wealth, and that choice adds up to a lifetime of working for someone else's dream instead of your own. If this changes how you see your career, subscribe. Comment below with your salary and last raise percentage. Let's see how many people are trapped in the 3% prison. Now go build something that's yours.